Yo, what's up everyone? It's your boy Looney back with another real one. Today I want to break down the biggest mistakes I've made trading options so far this year. Not just little slip-ups. I'm going to be talking about the kind that actually cost me money, taught me lessons, and made me rethink how I move in this game. Before we dive in, quick shout out to the Discord. Free to join, and then if you want real-time trade alerts, coaching, giveaways, and a community that keeps it real even during drawdowns, all the links are in the description. I'm doing a giveaway for premium members. You could check it out. I will announce the winner tomorrow. But let's get into this. Number one is selling puts with too high of a delta. So earlier this year, when everything was running up, I got a little too confident with things and I started selling puts with deltas like 40 and anything above 30. I was fine. The market's strong and I thought there was no way we revisit those levels. Well, the truth is we did. And because of those high deltas, I got assigned way too early on stocks like Riot at strike prices that now feel too high compared to where they're currently trading. And if I had just gone for that 20 or 30 delta, I'd be in a much better position and maybe not even assigned. And it was per greed on the premium. So if you look at Riot and I have 800 shares, my average cost is 9.26 and Riot is down to $6. So if I just went a lot safer with my trades and waited for these pullbacks and not gone all in, I'd have a better return and a better entry price and more cash on the side to do more. Now I'm in a position where I need to hold off for a little bit because of my diversity. Actually, now looking at it because of SoFi, my diversity has decreased. But overall, it is in a position where I'm going to have to make real moves, whether I want to get assigned at lower prices or just hold it. So if we look at some of these puts, let me just scroll down to when I got assigned. I have a $10 put and I have another $10 put, an $8.5 put. That one's a little bit better because it's lower than my average cost basis. And that's what I want to get at. What I should have done is really just paid attention to my cost basis. So if the stock is trading above my cost basis or slightly at it, you always want to be choosing sell puts that are obviously lower than the stock price, but I'm going to go even further. It's good to trade if it's below your cost basis because you're trying to bring that cost basis down. And if the stock falls, at least you're falling with it or your average cost is falling with it. Whereas in this scenario, I was doing average costs that were actually higher than my cost basis. You could see here, 9.26 is my average cost, and I was selling $10 puts. So that's bringing up my average cost. That's not what I want to be doing. Now, when you sell puts, you want to be looking at that 20 to 30 delta, and that's where they went wrong. I was really just choosing at the money at that point because everything was rising, especially during February and December to February. Maybe not February, but late December, early January is when I was doing these trades, and then February I got assigned and all that kind of came crashing down. But how I'm kind of learning from it is I plan to sell puts again. I'm going to sell puts at lower deltas, and Riot is actually a really good entry to get more assigned, to get even lower cost basis, get that number down. And I will be opening up another trade, hopefully market open on Monday. I have a feeling Riot's going to go up if this trend continues with how the market's performing. And staying on Riot, we're going to go with selling put credit spreads too early. Now, this one actually I think hurts a little bit more. And I was trying to get ahead of the curve, open spreads when I saw everything crashing down. And I thought it was a good time because the market dropped and I thought I was getting a little early, but that wasn't the case. The market had way more room to fall and those spreads just got cooked. I mean, some of them did well, but for the most part, they struggled. And when you sell credit spreads in a high volatility environment, timing does actually become very important, and you want to be reactive, not predictive. I was slightly too early, and being early in spreads is the same as being wrong. So I'm going to scroll back down to my history, and a few of these actually were fine. They did do okay, but a lot of them I had to sell for a loss. So you can see here minus 53, minus 53. I don't know if this is actually showing like the realized loss. So this one had a loss of $42. This one is nothing. And same thing, $42, another loss. But I had a few good ones. Let me see if this one again, another loss. And let's go to this next one. Another loss, or I'm not even sure if I clicked on the same one. And yeah, I really just got in too early with these spreads. I know I have one that did okay. This one I made $10, so very small profit on that. But that's really what you want to do when you want to sell credit spreads. You don't want to go all in. Luckily, I didn't use a big position. You could see I only used maybe a couple hundred. And although that is a lot of money, but on my overall position, that's not more than 5% of my portfolio. So you don't want to be going more than 5%. Honestly, 1% or 2%. You don't want to go more on these kind of trades. And at least I followed that rule. And I didn't lose a whole lot. I did lose a couple hundred or maybe 200 or 300, as you could see. And it does hurt. I could have used that 300 to sell more puts or collect more premium or to just do anything else or even just wait it out. Like even now or a little bit before wouldn't have been a bad time to sell credit spreads, or maybe not even sell credit spreads on Riot because of how volatile the stock is. It is a very volatile stock. It moves, it's correlated with Bitcoin and crypto, but it does kind of do its own thing with the timing of stuff. So it's a very volatile stock. Lastly is we're going to move on to this SoFi. I got into a long-term LEAP option, and a LEAP is just a long-term, so a long-term option. So about a year, a little bit more than a year or about that year expiration is a long-term position. So that's what the LEAP is, and then long just means I bought it. So I bought a call. So I'm betting that SoFi goes up, and I thought I was timing it maybe not at the best time, but I thought it was so far out in expiration, I didn't really need to time it. And it turns out I was actually really just catching the top. And now that call is pretty deep in the red. I'm down 40% on that. And while I still believe in SoFi long-term, the lesson is here. Just because a stock is doing good doesn't mean it's going to continue to follow that trend. So, and that's what happened. So the stock was, when I bought it, was pretty high. And I bought it on the 8th of January, and I bought it for $760. So that long call should probably be a lot cheaper now. Yeah, I bought it on the 8th, so it was $14, so really high up from today is about 23%. And if we look at that $10 call now, that same exact one, it's only $435, so a lot cheaper. And I mean, now wouldn't be the worst time to do it. There might even be, I did do another trade with SoFi call, and that one was fine. I did it at the $7 call, and I ended up closing it because of, I just had a feeling with all the different news and updates with the tariffs that it was a good time to get out of it. And I made some money on it. I think I made 10% in a few weeks. I'm trying to see what the break even is. Oh, it's almost 13. So if SoFi drops again, might do another long call. But the way I'm really going about that one, or how I'm trying to save it, is you could actually run a what's called a poor man's covered call. So when you buy a long-term call option, it acts as if you own the shares. It acts as if you own 100 shares. And when you own 100 shares, you can run covered calls. So I'm able to run covered calls on this option. So I can't really show it now. Maybe I can if I go to my history, but I only have, well, now I have 400 shares. So it's a little confusing. But at the time I had 300 shares, but I was able to sell 4 contracts. So more more contracts than shares. So because of that extra option trade of that long-term call option, acts as if I have another 100 shares and I'm able to sell a covered call. Now I'm going to go a little safer with those kind of options because it gets a little interesting, because if the stock starts rising past the covered call, you're in a gray area where you're kind of in the profit but kind of not. You might want to close your long term, or you could just roll your covered call. So I might do that. We'll see. And that's why I'm going to be very safe. I don't even want to think about that kind of situation. And I'm going to go very safe on those when I have to do a poor man's covered call. And if you want to learn more about how I do these trades, I do go over it in my premium Discord. And I have a course for the beginner level, selling puts, selling covered calls. So the very beginner-esque, but hopefully I can start doing poor man covered calls, tutorials, and the more advanced. I don't want to do it yet. One, because I haven't done it as long as the beginner level strategies, and it is more complex. And two, it's just because it is more advanced, and I don't want people to use money that they can't afford to lose. And that's the issue. So what am I doing now with all these situations? One is I'm selling puts at safer delta levels, so closer to that 20 to 25 delta. And then I'm also avoiding credit spreads for the most part, unless the setup is very clear and tight. Right now, there's so much uncertainty that stocks can flip up and down in a blink of an eye or just one tweet. So doing those kind of those trades are a bit risky right now. Who knows, down the line, I might do them again. And then I'm only entering long-term call options when there's actual momentum or some kind of support. And I'm more focusing on the support aspect of it. So I saw SoFi dipped a ton, and then I thought to myself, and also I just analyzed the stock, that it might dip a little further for the short term, but long term, I don't see it at this price, whatever it was. It might have been below $10. Last thing is, I didn't really go over it in this video, but I'm constantly doing it, dollar cost averaging more than speculating. So I'm putting money in every week, every day, depending on what position I'm doing. Selling puts is a form of dollar cost averaging, so I am doing that with this. And then the last thing is just keeping cash on the side. So I went a little too all in on the selling puts, and I got a little eager. Like I said, I went too early on a lot of these trades. So I'm really trying to stack up some cash on the side for better entries. And that's better for long-term. Sure, stocks go up and you don't want to miss out on the opportunity costs. But when things dip and you decide to put more capital into that, your returns are a lot better and there's less stress. So having more cash on the side is a really good strategy that I plan to have. And if you made some of these mistakes too, you're not alone. It is a part of the learning process, and I'm also here to share it all with you. Drop a comment. What was your worst trade this year so far? I'm very interested to see those. And then like, subscribe. And if you want to trade smarter with me in real time, check out the Discord. Until next time, peace.